All right, so today I'll be teaching you exactly the 6 things you need to know to be a trader. All right, so when I first started trading, there was a lot of bullshit online, and yeah, this is literally everything from my experience that got boiled down to what's actually important. All right, so just a quick disclaimer, I am sick, so I'll be coughing a lot, as well as this video is going to be unedited. So if you're not going to be able to pay attention, then get the fuck out of here. Trading's not for you. All right. Whoa, did that just get brighter? Did I get brighter? All right, back to the topic. All right, so the first thing, the most important thing is to understand liquidity. All right. So there's 2 types of liquidity. There's buy side liquidity and there's sell side liquidity. All right, so basically, in a sense, you know what a stop loss is, right? Everybody knows what a stop loss is. On a retail level, and even like sometimes on an institutional level, stop losses get placed on swing highs and lows. So in this case, let's say somebody entered a short early on, their stop loss would go right here, take profit down here, right? So they target swing highs and lows, right? So let's say another person entered somewhere around here, right? Let's say over here, they would go here and then place their stops here, right? Or maybe let's say that they entered somewhere here, maybe they'll place their stop losses there, right? This becomes liquidity, all right? Because now we know, or the banks or whatever, the markets, the algorithms, they know where the stop losses are, right? They know, like, logically, psychologically, where people place their stop losses, and that becomes something called a liquidity sweep. In this case, because it's up, like, right, it's a high, like, I guess you could say local max, if you guys remember your advanced functions or calculus. This local max becomes something called the buy side liquidity sweep, and what happens is price actually goes up to that buy side liquidity sweep, right? Takes it out. Sometimes it retests and it starts going the opposite direction. Okay, so you could have caught a short there, or even in this case, look at this swing high. What happened? Boom, right? So this is actually two equal highs. We swept it and then shot down, right? So you could have caught this. You could have caught that if you knew what you were doing, right? So yeah, that's the liquidity. You gotta understand, and this is something that took me a while to understand. You know what? Let me zoom in onto my face so to make this extra clear. You gotta understand that not everything is a liquidity sweep. Not every swing high is a liquidity sweep. Not every swing low is a liquidity sweep. But there's reasons for why something would be a liquidity sweep, right? So the way I look at it is sometimes there's confluences that add up. So I'll teach you guys what a fair value gap is later. But see, in this case, there was a fair value gap here that added to this buy side liquidity sweep, right? So it strengthened it. But also another way to think about it is, like, the market does not like smooth edges. It does not like smooth edges. So if you see something that's really smooth, like a high that's really smooth, most likely we're gonna take it out, right? We're gonna take out that high. So look, let's go back to this example. These highs, they were really smooth, right? So the market, it doesn't like smooth edges, so we have to make it jagged, right? That's something that ICT says a lot. So we took this out. Also, another way that you could see if a liquidity sweep is strong or not is if there's relative equal highs. So in this case, there's literally 2 highs that were equal, and then we took that out before shorting. That's literally what this part was. See, if I look at this, the highs, they're equal highs, so we took that out. So that strengthens the liquidity sweep. Okay, so that is an immense amount of knowledge in the first 5 minutes. So I think I deserve to promote my Discord server. I literally have a free community, a free Discord community where we trade every single morning, every single night. We just hang out, we trade. Sometimes it's a little weird, but yeah, it's actually fun. It's a nice community. I think, like, you guys should be involved in it. Look at all the profits. Like, everybody's banking. We're all helping each other become profitable. But yeah, You know, so we even have like a gambling bot. You know what? Fuck it. Let's hit some roulette. Let's hit daily. Roulette. How much that makes for the day? 13,000, huh? Okay. On red or black? Red. Let's see. Let's go. We banked. All right. Back to the video. Now that liquidity sweeps are out the way, the next thing I want to talk about is fair value gaps. I made a bunch of videos on fair value gaps, but it's basically when we have 3 candles in a row, right? Let's look at this. This is a fair value gap. So we have 3 candles in a row. This is the first candle, second candle, third candle. It's when the highs of like the outer candles, like the highs and the lows, don't merge. So in this case, look, this low, the open, did not merge with the high. So that becomes a fair value gap. Do you see that? It creates a gap in the market. Even here, this high did not merge with that low. That becomes a gap. Okay, so why is this important? And it's important because it shows or helps us understand where price is gonna move. So let's say we have a oh frick, I forgot to show my beautiful face. Let's say we have a fair value gap like this. Okay, this is showing that like when a fair value gap shows up, that means it's like price is very volatile in one certain direction. Okay, so in this case, we had so many buy orders that we couldn't even fill any of the sell orders. So what happens is price wants to rebalance that inequality, right? Rebalance that inefficiency. So what we did is we came back and we took it out. We rebalanced it. In this case, we inversed it. This became an inverse fair value gap because usually what happens with the fair value gap is like, here's a prime example. This is actually why I entered. Look, there's a fair value gap right here, right? This is a regular fair value gap. What happens is we touch into it and we react right away off it, right? And another crazy thing I'm about to show you guys that a lot of people gatekeep is the bottom section of the fair value gap usually remained like if it works, it's usually the bottom section that it reacts off of, right? If it goes up into the top half, there's a chance that it will have a reaction off it, but like chances are lower. So look at this. We went to the bottom half and we reacted. As we were reacting, I'm like, okay, this is starting to short. So I took a tape trade. Okay, I don't usually trade at this time, so that's why I demoed it or taped it. I'm tape reading it. So boom. Fair value gaps. I taught you inverse fair value gaps. Inverse fair value gaps are literally the same thing, except like instead of reacting off it and going opposite direction, we run through it. But this in itself becomes like kind of like a zone of resistance, or I don't know, support resistance, but it kind of becomes like a resistance. So what could have happened is we come into this inverse fair value gap and then react off it, bounce off, right? Fair value gaps are super important. Literally, if you truly understand fair value gaps, you could become like profitable off of like liquidity sweeps, fair value gaps, and time. Okay, time is the most important. That's why I have a bunch of exclamation marks. When you enter the market is really important because the algorithms are time-based models, right? They're time-based. One thing that you gotta understand is like you gotta trade in the kill zones. Okay, so if I put on my kill zone thing, you gotta trade it usually in the New York session. This is when most of the volume is occurring. This is when most of the movements are happening. Or London session. London session is really good. So in this case, you're probably wondering why am I trading Asian session? Well, because I'm trading an Australian currency. So it's pretty volatile in Asian session as well. Okay, so this is a 10-minute video. Damn, I gotta speed up. So time is really important. Time is really important. Now the next thing I want to talk about is order blocks and breakers. Also time, there's more things that goes into it, like micros and shit. If you want more information on that, comment down, I'll make a video on it. Alright, so now let's talk about order blocks, breaker blocks. Order blocks and breaker blocks, I entered the short based off of order block. So let me turn this thing off. So do you see how we came into this order block right here and we reacted off it? We started moving down. I entered off of that. Literally, touched it, and it started reacting off of it. It's kind of like a zone where price started to kind of reverse in a sense, right? I don't know how to properly articulate it. You should watch ICT for this. But like, say I have candles like this, right? And it kind of starts swinging away from it here. This top candle would become an order block or an inducement order block. Inducement blocks, that's kind of like a different strategy. It's not really ICT anymore, but yeah, it's really important to understand order blocks, and breaker blocks are literally the opposite of that. So it's kind of like we made the swing low. For example, over here, this is a breaker block. We made the swing low, but we inversed it, right? Maybe this is not actually a breaker block because we didn't fully inverse it, but that actually, no, it is a breaker block because over here we inversed it. So boom, there's a swing low right here, and then we came and then we took it out. So these candles right here, they become breaker blocks. So look, if we look at it here, it's like this is how it would be. So let's say you have like a high, a low, and then we kind of take out this high. There's an order block on this high. We take it out, we inverse it, we come back. Usually we would react off it. That would be a breaker block. Do the opposite for do the opposite for like bullish thing, right? So boom, look at this fair value, got 5 minutes. It looks like we're reacting off it, right? All right, so next thing I want to talk about is SMTs. So SMTs is when one pair, you have two correlating pairs, one actually starts going up, right? And the other one starts going down, right? These pairs, like one is going to basically be predicting the future of the other pair. SMTs are really important. SMT would make any setup A plus or kind of increase the grade of it. So boom, that would have been SMT. So in this case, I have an SMT here. If I go to its correlating pair, the New Zealand dollar thing, as you can see, like New Zealand didn't even take out this high, right? We didn't even touch it. And Australian, we literally took out that high and we took out other highs and stuff. So technically this could be the SMT right here, but I don't know. I think it looks prettier here. It looks better for the video aesthetic purposes. So I'm gonna place it down there. Okay, that's SMTs. I'm kind of trying to speed run this because I don't want to make the video too long. All right, and change in state and delivery. I made a video about this, but basically, whenever we touch into a high time frame PD array, and we kind of reverse it, like the candles that led up to it, it becomes a change state and delivery. So this is a change state and delivery. Do you see how we kind of went into a higher time frame order block, and we came down this sequence of candles, we took it out, and we went past this open. This becomes a change in state and delivery. So this is kind of like a confluence to show us that price is actually going to start inversing, right? Or switching directions. Something that happens a lot with change in state and delivery is price would react to it and then come off it, because the change in state and delivery basically becomes a breaker block, right? So yeah, that's really it. See, and over in this trade, first of all, we are respecting the halfway zone of this. You see how we didn't close? The wicks don't matter. It's more about the close. But here, this is a liquidity sweep, a sell side liquidity. So you kind of want to take partials along the way. So if this was a real trade, when it touches this, I would have taken off like maybe 70% of my position, and I would have let the runners ride to this swing low here, which is a 1 minute swing low. But I kind of placed it on the open. So you could have technically went for the close. I mean, for the wick, that would have been a better RR. But like, you know, I'm not trying to be too risky, too greedy. All right, so literally that's it for today. These are probably the most important confluences that like ICT has. There's some other stuff that like are interesting and could help you, but it's not necessary. Like the new day opening gap, new week opening gap, like those stuff that could help you. Or even things like standard deviation to figure out where to place your take profits. You want me to make a video on that? Let me know. I will. But yeah, again, I want to kind of talk about the server. You guys should join. See, people were like giving calls and stuff. It's free. It's literally free. I have no idea why. If you really want to be a trader and you think like trading is like what you want to be doing, I don't understand like why you wouldn't join the server. It's fun. All right. Yeah, that's it for this video. I'll see you guys later. Peace.